Next, I want to demonstrate how to model a stock index using a GBM process. We'll begin by downloading daily data for the S&P 500 index from 2000 through to today, the end of September 2022. We'll then estimate a GBM process to represent the index and simulate future price paths for the index over the next 100 days. And then finally, we'll plot those sample paths as well as the mean of the process. Let's begin by downloading data. And when we do that, create a time series with 692 daily data points. We can plot that time series on a chart, and we can see the downturn in the index at the beginning of 2020, the long trend upwards through to the end of 2021, and then the current regime in which the index has been declining steadily from the start of 2022 through the end of September. Let's now estimate a GBM process, which we do using the estimated process function. And that yields the following parameter estimates. First of all, the initial value, x0, is 3234.85. The drift in the process is estimated to be 0.00036, and the standard deviation 0.016. Notice that the standard deviation is 2 orders of magnitude larger than the drift in the process. The next step in the process is to estimate a number of sample paths from the process over the next 100 days. And we'll create 100 sample paths. We'll convert them to a time series and get ready to plot them. And then finally, we'll estimate the mean of the simulated paths to find predicted values. We'll then combine those sample paths with the estimated mean of the process, all on the same chart. And you can see that the estimated process yields an upward drift in the process over the next 100 days, but there's a considerable variation in the sample paths around that mean, with some very much higher and many considerably lower than the current value of the index. Well, this seems like a fairly straightforward process, but what are its limitations? Well, the two key limitations are that, firstly, we're assuming that the drift in the process is a constant. And while it's true that over a period of many decades, there is a small upward drift in stocks, it's also the case that for periods, sometimes lengthy periods, the drift is very much lower and sometimes even negative. And here I'm thinking of periods in the 1970s, for example, the beginning of 2000 through 2003, 2008, 2009, and more recently, for example, from the beginning of this year, 2022. The second assumption that seems rather unsafe is that the volatility, the standard deviation of the process, is also considered to be a constant. And this too appears unlikely. There are many periods, such as the current period, in which we're seeing elevated levels of market volatility, where the VIX index is in the range from 20 to 30, as opposed to in the middle teens. And there have been periods when the reverse has been true, through, for example, 2006 to 2007, when the VIX index was barely able to make it into double digits. So both of those assumptions, a geometric varying motion process, appear unsafe and could easily mislead us as to the likely future path of the index going forward. But it's a very good starting point for modeling purposes, and it can be extended in several ways to include time varying drift and stochastic volatility.